Good evening, ladies and gentlemen. Welcome to the March webinar for the Self-Managed Super Fund Club. The Self-Managed Super Fund Club's main focus is to educate trustees so they can make informed investment decisions, but also be compliant with their compliance obligations with the Superannuation Industry Supervision Act. As a part of that, we draw together experts from all different aspects of the investment universe. And today we've been lucky enough to be joined by one of the leading, if not the largest, exchange-traded funds provider in the world, which is iShares, and particularly the individual Alex Zyker. Before we get into the exchange-traded funds, what is an ETF? For me, over the last few years, we've seen a lot of companies turn up in their individual sectors to be a disruptor. One of the main disruptors over the last few years that has really gained a lot of traction is Netflix. You look at companies that have failed to adapt to the technology world, in particular in the movie industry, like Blockbuster, where we used to go to the corner store, the shops, and choose our DVDs for the weekend, especially on a rainy day. That has been replaced by online video streaming. And Netflix have changed the market and how we go about watching our entertainment. Another disruptor in a different sector is Uber. Like Uber don't do that much different than what a taxi would be, but it's not smelly. They give you a mint and a bottle of water, and they're generally a lot friendlier and a lot easier to access. Uber is new to the world, especially here in Australia, but has certainly disrupted the taxi industry. Why I talk about disruptors is one of the biggest disruptors that we've ever experienced in the finance and investment world is exchange-traded funds. Exchange-traded funds have been introduced as a low-cost means to gain a diversified portfolio. It has really created a competitive environment for fund managers. It's changed the investment landscape and certainly enabled investors, including self-managed super funds, to access quite easily different indexes around the world. So it's a bit about ETFs and why we're talking about them tonight here at the SMSF Club. More and more of our investors are asking about exchange-traded funds and certainly having them as a key component of their portfolio. Tonight, while the SMSF Club hold an Australian Financial Services licence, tonight's presentation is just general advice. That means is that we haven't considered your individual investment circumstances when we put together this presentation. But following the event, if you want more information about ETFs and how they might suit your portfolio, by all means speak to your SMSF Club advisor. So as I mentioned, we're joined by Alex Zyker. Alex Zyker is the director of iShares Wealth Advisory team here in Australia. iShares are the largest exchange-traded fund provider in the world. He helps private client advisors build better investment portfolios with ETFs throughout the country. I've known Alex for around 10 years. While Alex joined Macquarie Bank after I'd left, we both did work for Macquarie at some point in time. I think Alex was there from 2007 to 2010. I finished up in 2005. Following Macquarie Bank, Alex went across to Barclays, was the head of advisor sales at Barclays, and that's where I was able to spend a bit more time working with Alex in a professional capacity. He's got more letters after his name than what's in it. He's got a Master's in Applied Finance, he's got a Diploma in Financial Planning, he's got the highest possible derivatives accreditation in the country. More importantly, in his spare time, he spends that changing nappies, which I can relate to. He's got 2 kids, both aged 1 and 3, so he's certainly head down, bum up, looking after the family. But if he does get permission from his wife, he loves playing any type of sports and no doubt supporting it. So Alex, thank you for joining us.
Thank you, Justin, and thank you for everyone dialing in to listen. It's actually a great pleasure to talk to self-managed super fund trustees. One, because the self-managed super fund sector is I guess the fastest growing sector in the superannuation industry, but also self-managed super funds are probably the largest users of ETFs here in Australia as well. Just by way of background, I know Justin did touch a little bit on BlackRock, about BlackRock and iShares. So BlackRock, $4.6 trillion globally in terms of what we manage. We happen to be the largest asset manager in the world, and iShares make up 1.1 trillion US dollars of that. So we are the largest issuer of ETFs globally. We have over 700 ETFs, and we are also the largest issuer here in Australia. We have 31 ETFs here, and about $7 billion under management. Now, I don't say that to make you think that iShares are the best. The reason I say that is it should give you comfort that if you do decide to invest using ETFs and you do decide to use iShares, you should have every comfort that we know what we're doing. We do this all over the world. We've managed it through lots of different business cycles, and we've got the right or the correct risk management systems in place. Now, what I wanted to talk to you about today, first of all, probably what the most important thing is, what are exchange traded funds? What are ETFs? I want to talk to you about why investors have chosen to use ETFs, why ETF usage has absolutely exploded both here in Australia and in overseas markets. Importantly, I'll talk to you about how to buy ETFs should you choose to include these in your portfolios or your self-managed super funds. I'll also talk a bit about the questions you should be asking an ETF issuer, because not all ETFs are created equal, and there are some nuances that you should be aware of. And then finally, we'll finish up with a few portfolio examples, just a few ideas about how you may be able to incorporate ETFs into your own portfolio. And of course, the all-important disclaimer, as Justin said, this is not financial advice, so please seek financial advice before implementing any strategies. Now, there's a fundamental shift occurring across the globe. What we're seeing is, I guess, a migration of assets from those traditional managed funds that manage towards a benchmark, fairly low tracking error, but generally fairly large fees or high fees. And we've seen money flowing out of those types of funds into one, high conviction outcome-based strategies, so these are actively managed funds, but also into ETFs or efficient ETFs. We've seen this globally, and we're seeing this in Australia now. Now, in terms of the global landscape and the assets under management globally, if we just flick over to the next slide, you'll see that there are nearly 6,000 different exchange traded products or exchange traded funds around the world. In terms of the assets under management, there is nearly $3 trillion. And thinking about the Australian superannuation market, it's just about 2 trillion. So the ETF industry globally is bigger than all the Australian superannuation industry, and it continues to grow. In the blue line there, total assets under management, and in the green bar there, you'll see the market share that iShares have. So we represent just over 30% of global assets under management, so certainly a very large player with a lot of experience. So let's move on then. What is an exchange traded fund? Well, it's all in the name. It's a fund, something that investors have been using for decades, assets held in custody on behalf of investors, but they are exchange traded as well. So that allows you to buy and sell an exchange traded fund just like you would any shares. So the way you buy BHP or trade your Westpac shares, the same thing is possible with an exchange traded fund. So if I just take an example, I mean, really the way we look at ETFs here at BlackRock and iShares, we think of ETFs as just being a technology. We could take a pool of individual investment grade bonds. These could be government bonds or corporate bonds. And many of you would already know that bonds do not trade on exchanges. They're actually over-the-counter type instruments. But we can take these unlisted bonds, wrap them into an ETF, put them onto exchange, and allow you to trade them intraday, any time of the day, just the way or the same way that you would trade any listed shares. So in effect, I guess what we do is we make investments that are difficult to access, or those investments that are difficult to trade. We make them very simple, one, to access, and then we also make them very simple to trade. Now, an interesting analogy that we use here at iShares is the humble container. Now, I'm told that the container was invented back in 1956. I personally would have thought that this was invented a lot earlier than that. But the question we get when we put up this slide is, why on earth are we using a container in an ETF or an iShares presentation? And let's think about what we did or how we transported goods prior to 1956, prior to the container being invented. So if we're transporting sugar, wheat, automotive parts, whatever it was, how would you move goods from one port to the other? Well, you'd have to pack or stack all of these goods, wheats, sugars, automotive parts, whatever it might be, onto pallets, put them up onto a ship, and transport them from one port to another. Now, what the container did was it allows us to uniform and scale the transportation of goods from one port to another. Now, what's important here is if we look within the actual container itself, we are transporting the exact same goods that we used to. So it's the sugar, wheat, or automotive parts. It's all exactly the same, but it made the transportation of goods from one port to another far simpler through uniformity and scale. So it's an efficient way to move goods, I guess, from one port to another. And an ETF is no different. It's a technology that allows an efficient way for a buyer and seller of investments to interact. But importantly, within the ETF, we are not transporting anything different. We are bundling groups of shares, things that we've traded for many, many years, or bundling bonds, things that we've been investing for many, many years, but we just make it more efficient. So we think of it as a technology. Now, another example that I like to use is one just to really put some life around it. One of our most popular ETFs here in Australia is something, well, the ticker, the three-letter code for this ETF is IOO. Now, this represents the top 100 multinational companies globally. So incredibly large businesses like Apple, Microsoft, Johnson & Johnson, Nestle, Google. Very well-known brand. But if you as SMSF trustees decide that you would like to go and purchase or invest into the top 100 companies across the world, what would you have to do? Well, first of all, you would need a trading platform that would allow you to buy offshore securities, because Apple and Google don't trade here in Australia. So you need a trading platform that allowed you to trade international securities. Then you would need to enter into 100 separate trades. Now, there is a cost. There's obviously brokerage for each and every one of those trades. Now, let's assume, for example, that each trade was to cost $40 to buy offshore securities. To do that 100 times, it would cost you $4,000 just in brokerage alone. So to buy the top 100 companies around the world, you would need a very large portfolio to justify the fees and the time that it would take to trade. Now, with an ETF or IOO, you can trade or you can buy this ETF in one simple trade, so it's one click, and it instantly gives you exposure to the top 100 companies across the world. Now, that's exposure to not only 100 companies, but 10 different countries, so almost 10 different time zones, 10 different currencies, or potentially 10 different currencies, and 10 different exchanges. So these are very efficient way to get instant diversification and very simple way to do it. So why have investors embraced ETFs? And one of the examples I've just talked through there, IOO, hopefully that illustrates it. But really, ETFs are the best of both worlds. On the right-hand side of the slide here, first of all, you'll see, well, ETFs are just like a mutual fund. So these are the investment funds that people have been buying and investing into for many decades. So assets held with a custodian in trust on behalf of investors, receiving all dividends and all associated franking credits and passing them on to investors. But ETFs are also a combination of a stock. Sometimes we say that if a managed fund was to marry a share, the child would actually be an ETF. So we take the best of both worlds, the mutual fund and the stock, and that there is your ETF. So what are the advantages of using ETFs? So why have investors embraced ETFs? Well, the first one is diversification. And I talked through an example of that being IOO, the top 100 companies across the world. So ETFs are made up of a broad portfolio of individual securities. They're highly diversified investment vehicles. Another example we could use is our corporate bond ETF that we have here in Australia. It's called IHCB, that's the ticker. There are 3,300 bonds in this portfolio, so incredibly well diversified, and investors can access that through one trade. They're very liquid, so ETFs are highly liquid, and they can be bought and sold during the trading day, and that's any time during Australian market hours. They're very cost effective. They're generally very low cost and far lower cost than your typical actively managed fund. So the cost of investing in ETFs is generally lower than an active fund invested in the same market of assets. To give you an example, we have our lowest priced ETF here in Australia is one called IVV, and this gives investors exposure to the S&P 500. So that's the top 500 companies listed in the US market. And the cost of that ETF is a mere 7 basis points. So if you were investing $10,000, to hold that ETF for the entire year would literally only cost $7 in terms of management expense fees. Accessibility. ETFs offer access to market exposure of a variety of asset classes, both broad and specific. You could get exposure to developed market equities. You can gain exposure to emerging market equities, small companies, large companies, high dividend paying stocks, domestic bonds, government bonds, corporate bonds, global bonds. You could get exposure to different sectors, and you might have a view on healthcare, or you might like to get exposure to global telecommunication stocks, or even consumer staples if you're looking for a defensive asset allocation. And finally, they're very transparent. At iShares, we publish our holdings every single day. Again, the best way to illustrate this is by way of example. We recently had a call from an investor. This is the time when VW was going through its emissions scandal. So we had a call to our desk here at iShares with a concerned client. They were worried what would happen to their portfolio and what their exposure was to Volkswagen. So on the website, we quickly showed the investor that their allocation or exposure to Volkswagen was 0.3%. So on a $100,000 investment, this client's exposure to Volkswagen was $300. So knowledge is obviously power, and the client was able to walk away and not be too concerned because they only had a $300 exposure to Volkswagen through their European exposure. But again, they're very, very transparent with everything published on the site every single day. So buying and holding ETFs. How do we buy and hold ETFs? Well, buying ETFs is no different to how you would buy or sell a share, and I suspect that many of you through your self-managed super fund have been buying or at least trading single securities or shares. So the process for purchasing ETFs is exactly the same way. So they can be purchased and sold anytime during exchange or Australian Stock Exchange trading hours. They can be traded using the same order types that you would normally use for your shares. So you could place a market order, a limit order, you could put a stop loss order in place as well. They're priced on the ASX intraday, so that means that you can view the price movements exactly the same way that you would see the movement in shares. So you know exactly what price you are getting when you purchase the share, and you know exactly what price you are getting when you sell the share in the ETF. Now, if we compare that to a managed fund, typically if you were to invest before 2 p.m., you might get the end of day closing price. But as an investor, you really have no idea what that end of day closing price will be. Whereas with an ETF, you know exactly what price you get. And importantly, there is no minimum investment when purchasing ETFs. Now, I should point out that, of course, when you are purchasing ETFs, just like you would do with any listed share, there are likely to be brokerage commissions that will apply through the trading platform that you use. What happens after you buy? So first of all, you receive a welcome pack, and this is sent out from ComputerShare. In there will just be some information about iShares in general, and an example or a summary of what you've purchased. You can manage your holdings through the ComputerShare website, or you can manage your holdings through your trading platform, where you can probably view all of your exposures or all of your holdings, not just ETFs but also your shares as well. The distributions, this is important because this is a question that is often asked of us. What happens to dividends and the associated franking credits? Now, with an ETF, all dividends that we receive from the shares that we own, so for example, there is an ETF called ILC, which is the iShares Large Cap ETF. That holds the largest 20 companies on the Australian Stock Exchange. So the big banks, the miners, Telstra, etc. Now, when the ETF, given the ETF owns those shares, when those shares pay a dividend, we will pass those through the ETF to you as the investor, and you will also receive, if you're eligible, the associated franking credits with those distributions and those dividends. For most of our ETFs, we pay distributions every quarter, and some of those some are half yearly. And then if you'd like to access ongoing information on the ETFs that you own, you can do so via the iShares website, which is very comprehensive. All the holdings, the geography, the geographies that you're exposed to, performance history is there, all the different portfolio characteristics. And if we flick over the page, I've got a screenshot here, or a couple of examples of what you can see on the iShares website. So first of all, on the left-hand side, you can see a performance chart of your ETF versus the benchmark that it's tracking. You can look at the returns. If you click the tabs, so just under performance, you might see this on the top left-hand side. You can see chart, returns, distribution, and of course the all-important tax summary, which your accountants may require or will require. Then on the top right-hand side is your exposure breakdowns. So you can see geography or sector, and in this case, what we've used here, the example I'm using here is actually IOO, so the top 100 companies across the world. So you can see there that your exposure to information technology is 22.18%. Where does that exposure come from, or that sector exposure come from? Well, at the bottom of the page, you can see I've just shown you there the top 10 holdings, and you can download all the holdings on the website. So the largest holding there, you can see Apple being 6.39% of this ETF, followed by Microsoft, Exxon, Johnson & Johnson, GE, Nestle. So you can see very large brand names, and I suspect that most of you as trustees or just people in general will have a lot of the products at home that are produced by some of these companies. So that information is all there for you. Now, in terms of trading, what are the best practices? What sort of things should you be doing and looking out for? Now, first of all, you should trade when markets are most active. Now, for those of you that are experienced share traders, you will know that the Australian Stock Exchange has a, well, not all stocks trade at 10 a.m. There's a staggered open. So AMP, being the letter A, trades before Westpac. So ideally, when you trade ETFs, you should trade when the underlying market is open. So maybe trade from sort of 10:30 onwards. Avoid trading in the open and in the close. And if you decide to trade offshore markets, so for example, you might decide to buy IKO, which is your Korean exposure, or even IJP, which is Japan, ideally trade when those underlying markets are open. So although the Australian market is open at 10 a.m., Korea and Japan aren't necessarily open, so you may trade at sort of 11 or 12 o'clock when those underlying markets are open. Ideally, it's best to use limit orders. That way you know what price you're getting rather than using market orders, and here you can avoid potential slippage. And then for larger orders, you can actually contact the iShares trading support team or the capital markets team here, and that number there is up on screen. So that's 0292722345. Now, normally for larger orders, that's amounts sort of $500,000 plus, but if you're just getting the hang of trading ETFs for the first time, by all means, you can contact the desk and we can talk you through what to do. So let's move on and look at due diligence, or what sort of questions should you be asking an ETF provider, or what sort of questions should you be trying to get answers for before you actually invest into an ETF. So first of all, exposure. And let's assume, for example, that you decide to partner with the right ETF issuer, because there are, I think now, eight different ETF issuers in Australia, and there are over 130 ETFs listed here on exchange. So first of all, exposure. Does the ETF give you or deliver the desired exposure? So you might want exposure to smaller companies, or you might want exposure to a particular sector. Does that ETF give you exactly what you're after? The structure. How does the ETF deliver the market exposure? Is it a physical, and I'll talk more about this, is it a physical ETF or is it a synthetic ETF that relies on derivatives? Thinking about the tracking difference or the tracking error. Now, all ETFs exchange traded funds are tracking a particular benchmark. That could be the ASX 200, so the Australian share market, or the S&P 500. Have a look closely at how well the ETF actually tracks that benchmark. The tighter the tracking, the better the performance, or the better the outcome. Liquidity. How well does the ETF provider support trading in the ETF? There are professional traders called market makers, which are obliged basically to be on screen to help with liquidity. The more market makers in the screen, the better it is. At iShares, we work with 9 different market makers who will make markets in different ETFs. Now, ideally, you would want to have at least 2 market makers for an ETF, because that means there'll be some competitive price tension, and that's what we want. And finally, what's the cost? It's not just the stated management expense ratio. There are other costs to consider, including trading spreads. So let's move on. The first one is the exposure. Does the ETF provide you or deliver you the exposure that you're after? Let's think about Australian equities. It's very simple to say, look, I'm going to buy Australian shares, but what type of Australian shares would you like to buy? You might decide that you'd like large cap exposures because you want higher dividends or a larger amount of franking credits, and that there could be the S&P ASX 20 index, or the ETF that we have that tracks that benchmark is ILC. You may decide that you'd like to take a view on small companies, in which case the index that you would look for here is the S&P ASX Small Ordinaries benchmark. Now, the ETF that tracks that from iShares is something called ISO. Or you might decide that you'd like to target high dividend or higher dividend paying stocks. And in this instance, it'd be the S&P ASX Dividend Opportunities benchmark. Now, the ETF that tracks that is IHD. But what I'm trying to illustrate here is that although all 3 of these are Australian equity exposures or Australian share ETFs, all 3 of them will give you something very different. So have a think about what exposure it is that you'd like before purchasing. Now, what about the structure? There is a lot of publicity, certainly globally, around physical versus synthetic. What does it mean? Now, physical ETF will hold all of the underlying shares. So, for example, our ASX 200 ETF here, which is IOZ, we hold all 200 shares in the ETF. Whereas a synthetic ETF, what they would do is they are likely to buy some sort of derivative to get exposure to the ASX 200 rather than holding each and every one of the actual shares. Now, it's not to say that synthetic is bad, it's just that you need to be aware of what that means. And being a synthetic ETF will add a level of counterparty risk because you're exposed to the strength or the balance sheet of the issuer because they are obliged to deliver on some sort of performance, whatever that might be. Now, under normal circumstances and all things being equal, as investors, we should always look for physical ETFs that hold the underlying shares or bonds in the ETF. But sometimes it's not possible to get exposure to a particular market or sector using a physical ETF. So for example, oil. I mean, realistically, it's just not practical for iShares or other ETF issuers to go and buy or hold 20 million, 50 million barrels of oil. So in that example there, it's probably more efficient and easier to get exposure to the price of oil by buying oil futures or some sort of other derivative to get exposure to that. But of course, just coming back to counterparty risk, so with the physical ETF, there's generally no counterparty risk. With a synthetic ETF, there is. So as a result, in terms of credit risk, there is no credit risk through the physical ETF, whereas you can see there that it applies to synthetic ETFs. And normally you'll get full transparency for most of those exposures. We're fortunate in Australia that there are very few synthetic ETFs, and the ASIC has some very strict guidelines that if an ETF is synthetic or holds a large portion of its exposure via derivative, it must state so clearly in its name, and you will see that any ETF that is synthetic will have the name synthetic in its name. Now, moving on to costs. The simplest thing that people do, or most often do, is compare one ETF to another based on the stated fee or the management expense ratio. One ETF is 15 basis points, the other one is 20, so automatically they gravitate or lean towards the cheaper ETF. But it's not as simple as just looking at the stated MER. There's actually more to consider. So in terms of the cost of actually holding, if you hold an ETF for a long period of time, an indirect cost, or sometimes it's not an explicit fee, again, there's indirect, is the tracking difference. How well does the ETF actually track the benchmark? If the ASX 200 index was up by 10% and your ETF was only up by 9.5, well then effectively there's a 50 basis point cost to holding that particular ETF. So you want tight tracking difference. The total expense ratio, which I've mentioned, that's a fairly obvious one. The transaction and rebalancing costs within the ETF. How often does the ETF actually buy or sell the underlying securities? Less is better. And is there any securities lending? And of course, there's the cost of trading. So this will be the spreads, the buy-sell spread when you go and purchase the ETF, just like you would have a buy-sell spread when you buy a BHP or Westpac shares. And of course your commissions and transaction costs, the brokerage that you would pay when entering into a trade, just like you would do with number of shares. So we flick over, let me give you just a quick example, and this is just an illustration really. It's not a live example, but just to illustrate this point. We have three ETFs with different expense ratios. The first one, 19 basis points, the second one, 19 basis points, and the third being 24. So automatically you might assume that the third ETF is the most expensive, so let's not look at that. The other two are actually better. Now if we just click to the next slide, sort of moving, we'll see that the tracking difference for the three ETFs is actually different. So ETF 1 has a tracking difference of 19 basis points, ETF 2 has a tracking difference of 21, ETF 3, the more expensive ETF, actually has a far lower tracking difference. And trading spreads, you can see the three different trading spreads there, and when we add them up, in this example, over the longer term, ETF number 3, although it's more, the stated MER is more expensive, the total ongoing cost of ownership is actually less. So just pay attention to more than just the actual stated MER. All right, let's move on to some portfolio examples, because I think this is probably the most interesting part for you as SMSF trustees or self-directed investors. Global reach. Now, I talked about iShares being the largest issuer globally. We're also the largest issuer here in Australia. We currently have 31 different ETFs trading on exchange here, from developed markets, emerging markets, different sectors like telecommunications, global healthcare, global consumer staples. We have fixed income, both Australian and global. So as investors now, you can slice and dice your portfolio in many different ways. You can take very short-term tactical views. You might decide that you'd like to have exposure to Europe and Japan, given the central bank loose policy, or you might want to take something like IOZ, which is the ASX 200, as a long-term core allocation to your portfolio. Now, we've got some data here from the Australian Tax Office, and what this shows us is the allocation as of last year, or how SMSF assets are broken up and invested. And probably no surprise to any of you, the largest exposure or the largest allocation is actually to Australian listed shares. There's 31% of SMSF assets are actually in Australian shares. And I guess that makes sense, because as self-directed investors, you probably have firm views around which companies in Australia you like, and you're more confident and comfortable purchasing those investments. What's surprising, though, is the large amount sitting in cash and term deposits. Now, this probably made sense back in 2007, when the term deposit rates were close to 7% and the cash rate was up there. But now that the overnight cash rate here in Australia is 2% and you're struggling to get much more than that in a term deposit, I'm a little bit surprised that there is so much cash and term deposits sitting in the asset allocation of a self-managed super fund. It may be for good reason, but perhaps some SMSF trustees have been a little bit lazy and left their asset allocation as is. The thing that stands out for me here for SMSFs is there's actually very little in overseas shares. If we move around the dial from right to left, in the light green, you'll see 4%. That's the exposure to overseas shares. It is tiny. Now, remember that the Australian Stock Exchange, or the Australian market here, only makes up about 3% of global equity markets. So there is a world of opportunity and a lot of very large diversified companies that you could access overseas. So as a result, where are ETFs commonly used? And ETFs are commonly used to gain exposure to overseas markets, because remember the example I used, IOO, with one trade you can get exposure to the top 100 companies globally. With some of the other ETFs, you can get exposure to 500 or 900 different stocks in one different trade. Now, a very simple example. Some of you may have heard of the MSCI World Benchmark. This is I guess the barometer or the gauge for what global markets are doing. And many of our investors try to replicate that benchmark as a way to gain diversification in their portfolios. So you could do this with two simple trades. Now, if we were to allocate or buy two ETFs, the first one would be iShares Core S&P 500 ETF. So that is IVV, and that gives you exposure to top 500 companies in the US. And combine that with the iShares MSCI EFA ETF, which is developed markets excluding US, so that's Europe, Australasia, and Far East. If we were to combine those two ETFs together, we can easily replicate, or very closely replicate, the MSCI World Benchmark. Now, in the blue line, you will see the performance of the MSCI World Benchmark, and in the green line, you see the performance of these two ETFs, and you can see how closely they actually track that blue line. Now, the cost of this portfolio, or the weighted average cost, the composite management cost, are 20 basis points. So on a $10,000 investment, that would cost you $20 in holding costs over the 12-month period. On $100,000, it would be a $200. So if you think about that, it is a very low cost, it's very inexpensive, and you can easily replicate the MSCI World Benchmark. And within here, there are nearly 1,400 stocks in this portfolio. It's enormous. Moving along, maybe the World Benchmark isn't enough for you and you'd like to gain exposure to something a little bit more interesting, a little bit more volatile, but perhaps something that could generate some additional returns. And in this example here, what we show you here is an allocation or an investment, 10% investment in emerging markets. So we reduce our exposure to IVV and IVE by 5% each, so 45% in each of those, and a 10% allocation to emerging markets. And the ETF ticker, or the name there, is IEM. And you can see here, again, the benchmark that we use is the MSCI ACWI, which is the All-Country World Index, which actually incorporates emerging markets. And again, by using these 3 ETFs, you can see that you can track that benchmark fairly closely. The total cost, or the weighted average cost here, is 25 basis points. So again, on a $10,000 investment, that'd be $25 per annum, or $100,000, it'd be $250. So again, very low cost and an efficient way to gain exposure to global markets. You don't need to use emerging markets. You might take a view on Korea or Japan, Europe, global healthcare, whatever it is. We're just trying to illustrate or show you an example here. What about a diversified portfolio? Well, you can easily do that too. On our website, so on iShares.com.au, we publish a guide, some model portfolios, and these are just very low cost, simple solutions that you could use as a guide. By all means, you could replicate them exactly the way they are, or you could use that as a guide and you can make your own portfolio shifts depending on what your risk profile and view is. So we can see here there are 5 risk-based portfolios, from conservative all the way through to aggressive and everything in between. At the top of the line, we can see the weighted average management cost. So again, the total cost there is 14 basis points out to 19. And these ETF portfolios are comprised of 4 ETFs. So the exposure to the ASX 200 is through IOZ. So it's ASX 200. For your US exposure, it's the S&P 500, which is IVV. And I mentioned that we referred to these in the previous slide. Then other developed markets, ex-US, is IVE, and then for Australian government bonds and corporate bonds, we use IAF. And you can make your way along that chart there, and you can see the different allocations depending on someone's risk profile. Obviously, the more conservative an investor is, the more they will have in defensive assets like cash and bonds. Whereas if an investor was a little bit more aggressive, then they would have more in growth assets, being your Australian shares and global shares. Now moving along, why iShares? Now I talked about iShares being the largest issuer in the world, so that's fantastic. But in Australia, we offer the greatest range. I mentioned before, we have 31 different ETFs here in Australia and 700 globally. We offer both core and precision exposures. So core are those exposures that you're likely to hold for a long period of time. There are fundamental building blocks in a portfolio. An example would be the ASX 200, IOZ, which costs 15 basis points, or even IAF. I referred to that briefly in the previous slide, which is the composite bond, Australian composite bond ETF, and the cost of that ETF is 20 basis points. We believe we provide you quality ETFs with a standalone structure with daily transparency through to the underlying holdings. And of course, we provide you all the relevant support which is required, one for buying but also holding ETFs in your portfolio, and most of that is available on the website. Now the final slide I'd like to take you through is just a list of the ETFs that we have here in Australia. We highlight the ticker and also the fees per annum. Now if I just use the first one as an example, under Australian shares, if you as SMSF trustees or self-directed investors wanted to buy the top 200 companies in Australia, a simple way of doing that is to buy IOZ. So when you go to purchase IOZ, rather than typing in the ticker BHP as you would do for the BHP share, you would type in IOZ and trade like you would normally do for a listed share. The fee there you can see, or the fees per annum, very low at 0.15%. In fact, it's the lowest cost or lowest priced ETF that gives you exposure to the ASX 200 market in Australia. And of course, we have exposure to Australian fixed interest. A very popular ETF is the composite bond ETF at 20 basis points. In December of last year, we launched global fixed income. So exposure to global corporate bonds, investment grade through IHCB. We launched global high yield, where we've had a lot of discussions with investors about IHHY and also emerging markets bonds. And then on the right-hand side of the slide, you can make your way down the list of international shares, so from emerging markets to consumer staples, to Hong Kong, Europe, Asia top 50, and the global 100. That brings me to the end of the formal part of my presentation. Of course, there's a disclaimer on the side, and perhaps now we can open up for questions.
Thank you, Alex. That was very informative. To give people, listeners, a bit of an idea of how I've used ETFs in the past, back in 2010, 2011 it was, there was a lot of talk about the US property market. And I'm a contrarian investor. I like to take advantage of when what Warren Buffett says, there's blood on the streets. So in the United States, post-GFC, there was a lot of opportunity to invest in United States property. There was a lot of people going, hey, I'm going to go over there and do it the hard way, buying an individual residential property. And I found that very, very difficult and very, very risky. You take currency risks. You've got individual tenant risk. There was even talk, I watched a Four Corners episode where an Australian property owner who owned a property in the United States, the tenant didn't pay rent, and he ended up flying over there to go rattle his tin. Anyway, he was shot. So I don't know too many people that did it the hard way by buying individual properties in the United States that made money. But I decided to do it the easy way. I like doing things that are simple. So I actually gained exposure to the iShares US real estate ETF. So that gave me exposure to a diversified US real estate portfolio that was comprised of commercial property, industrial property, but also residential property. Well, I bought around $45, I think it was, where we gained exposure to it, and I sold out around $75 not that long ago. So I made quite a healthy return. But it highlights how ETFs have become the easy way to gain exposure to not just big markets like the ASX 200 or our banks, but those markets that aren't quite as easy to gain exposure to. With globalization, we can trade through ETFs any exposure pretty much that we want to gain exposure to, whether it's a technology basket, whether it's US real estate. Even if you want to gain exposure to China, it's very difficult to go buy the largest companies in China, but through the iShares ETF platform, you can. So we've got a few questions. If you do have questions, by all means, use the question box. I'm going to pass over to the expert to answer some of these questions. Here's one good question here. Do I receive franking credits if I receive dividends from an ETF? Can you please explain how franking credits work? Maybe over to you, Alex.
Okay, so great question, and this is a question that comes up time and time again. So if you, an investor, if you were to buy Westpac shares and you were to receive a dividend, there would be some attached franking credits to that particular dividend. Now, with an ETF, it's basically a fund that holds all assets or all shares with a custodian for the benefit of our investors. And as a trust, we must pass through all the dividends and all the associated franking credits. So you, as investors, if you hold an ETF that holds Australian shares, you will receive all the dividends and the associated franking credits with those dividends. So yes, you do.
Excellent. The question here is, what would be the average fund manager's fee? Now that's pretty broad question, but let's just say an Australian fund manager that's trying to replicate the index, the ASX 200. What do you reckon that like the AMPs of the world, their fund managers are charging Colonial First State? What do you think it would be,
Yeah,
Alex?
okay. So difficult for me to comment on specific fund managers without looking at what they charged. But generally speaking, from what I've seen, an actively managed Australian share fund would be somewhere between 60 to 90 basis points on average. But there can be some that are far more expensive, over the 1% mark. For global equities, they're generally more expensive. So at the lower end, it'd be probably something like 8 basis points, up to maybe 1.54 for some of the more commonly used bigger ones. So the ETF, if you were to compare the cost of an ETF with your traditional actively managed fund, they are far less expensive.
Excellent. Like if you look at the 60 basis points to 90 basis points for Australia, who's Australian fund manager who's trying to replicate the ASX 200, it's no wonder iShares are becoming so popular when its fee is, 15 basis points. It's a fraction of what the traditional fund managers have been able to get away with, which is great for SMSF trustees, great for investors. What are your most popular ETFs?
I guess. Okay, so some of the popular ones that we have, the most popular is probably IVV, which is exposure to the S&P 500, so the top US companies in the world. But IOO is very popular as well. I think IOO at the moment is maybe the 4th largest ETF in Australia, so that gives you exposure to the top 100 companies around the world. Global healthcare has been popular, and this is for people that believe in the aging population or changing demographics and buying into that particular thematic. And of course, from time to time, emerging markets are very popular. It hasn't been as popular now, given the fall in emerging markets and the sensitivities around commodities, but it's certainly an ETF that does get a lot of attention when markets turn. The other one I should probably mention again is IOZ, which is the ASX 200. I think that's very popular because that's the cheapest ASX 200 ETF on the market.
Wow. Question on synthetics versus those that are actually buying the underlying physical stocks. Is one of the benefits of a synthetic being would it be cheaper?
Not necessarily. I mean, theoretically, it could be. In terms of what we see in Australia, synthetic ETFs are generally trying to track markets that are difficult to replicate physically. So we don't have a lot of, I guess, price comparison here in Australia for physical versus a synthetic. So
if we're
I wouldn't
talking
say
about 15 basis points for ones that, like you guys, that are actually buying the physical, like, it can't be that much cheaper, and if it is, I doubt that I would take the counterparty risk of doing it just as an individual investor.
No, I agree with you with that one as well. So especially for Australian shares, because Australian shares pass through, will pay dividends and franking credits. It's important, if you'd like to receive franking credits in Australia, you have to physically own the shares. Yeah. Now, if you access Australian shares through a derivative, you do not physically own those shares. So as a result of that, you are not entitled to actually any franking credits. So definitely for Australian shares, it makes far more sense to be buying or holding ETFs that are physical rather than synthetic.
Yeah, as an advisor, I'd never recommend buying a synthetic. In fact, I'd do whatever I could to talk a client out of it for those exact reasons. Good question here from Jerry. He comes from Melbourne. It's probably a question that's important to address. He's asked, how long would an ETF investment normally run? Maybe you could talk about the fact you're owning the physical, it's indefinite, Alex, and like you can sell it whenever you like. So you've got the same liquidity as direct shares.
So ETFs are open-ended. They're not closed-ended. They would, last for forever and ever. The holding period for an ETF for an investor it's difficult to quantify that because every investor's motivations can be quite different and are different. Now we break up our exposures into what we call core and others being precision. So core exposures are generally those types of ETFs that you are likely to hold in your portfolio for a long period of time. Now what that means is that the impact of fees are probably also going to magnify over longer periods of time. So it's important for us as an ETF issuer to launch or offer core products as cheaply as we possibly can. So we use the example of the ASX 200. I mean, that is a fundamental long-term building block for an Australian investor's portfolio. So we do that at 15 basis points. Australian government bonds, and maybe some developed market global equities. These are core portfolios. So they could be held for months to many, many years. On the flip side, you might have things that are what we call precision instruments or precision ETFs. And again, they could be held for many years. It could be something like consumer staples, for example. So at the moment, given market volatility, some investors decide they will have a defensive allocation, so they may invest into consumer staples. Now, depending on how long the volatility persists, you know, they might hold it for a few days, they might hold it for a few months, or in fact, they might even hold it for a few years. So it's really up to the individual investor as to how long you keep that exposure in your portfolio, or you might sell it once it's hit its particular price target, wherever that is that you might set.
Excellent. Question from Wendy from Adelaide. The question probably is fitting for a lot of listeners, especially probably even more SMSF trustees that are so yield focused. Here in Australia, we love dividend income. Do you have an ETF that targets higher yield?
Yes, great question. In fact, we do. And again, it's a popular or common request from investors, especially for those in SMSFs or those approaching retirement or those investors that have already entered retirement. So the ETF that we have is one called IHD, which is the iShares Dividend Opportunities ETF. It basically invests into 50 Australian companies that have a high dividend paying amount or pay high dividends. At the moment, the net yield is somewhere in the vicinity, I think, about 7.2. Wow. So if we were to add franking credits with that, assuming that the investor is eligible for franking credits, you're looking at a gross yield of in excess of 9% at the moment. So Australian equities are actually a great way to generate meaningful levels of income, but just be mindful of the risk that you take on because you are buying exposure to shares.
That's an amazing point. Like here in Australia, we don't understand how lucky we are because companies have a very high dividend payout policy here in Australia. Like in the United States, the average dividend payout is like 1 or 2% if they're paying any of the profits out. Most companies in the United States retain profits to fund future growth. So they get a grossed up yield close to 10%. That is phenomenal. When you do look at the underlying risk of the companies that are behind that, to get that sort of yield, I would imagine it would be the top 4 banks, the Telstras of the world, IAG, Wesfarmers, those big blue chip stocks that are paying out high dividends at these levels. Would that be a fair assumption to say, Alex?
That's exactly right.
Right. Another question from one of our astute investors, Mark from Queensland. He asked, do we get lumped with capital gains and losses from your trading? So do investors get lumped with capital gains and losses when you rebalance the portfolio? I think probably is more accurate of what Mark's asking.
Okay, so there's 2 things to consider here. First of all, mark your own trading activity. So if you were to buy a share, a BHP share, obviously when you sell that, there'll be either a capital gain or a capital loss. Now, with an ETF, if you bought an ETF which was trading at $100 and you sold it at 110, then there would be a capital gain there of $10. No different to when you're trading your normal shares. So that's one part of the answer. The second part is being a fund, our capital gains or capital losses, well actually capital gains pass through to investors. Now, by design, ETFs are generally very tax efficient. Because they track a benchmark, there is generally lower turnover or lower buying and selling of the underlying securities or shares within the ETF. Now, if an ETF were to buy and sell the underlying shares very actively on a regular basis, then the ETF would also need to pass through the capital gains that are linked to that trading activity through to end investors. So yes.
Excellent. Look, just having a quick look at the time. We've gone for an hour, so if we haven't answered your question, what we might do is respond via email overnight, so you get a response sometime tomorrow. So look, thank you for all of our clients for tuning in. Look, at investment knowledge certainly does pay the highest dividend. Whether you trade ETFs or not, no doubt you've learnt a lot about the ETF market and how they're going to be a disruptor in the finance and funds management business. When you're able to gain exposure to basically the same benchmark of fund managers for a fraction of the cost, the growth of ETFs and the growth of iShares, I think, is going to be quite dramatic over the coming few years. Alex, look, I really appreciate a person of your caliber to take time out of your busy schedule to help educate our clients and SMSF trustees. So thank you very much for sharing your insight and sharing some of your expertise with us tonight.
My pleasure.
Everyone else, yeah, happy investing. Thank you.